The COVID-19 pandemic has left an indelible mark on the global landscape, and the U.S. economy has been no exception. Beyond the immediate health crisis, the pandemic triggered a series of economic shockwaves, disrupting supply chains, altering consumer behavior, and ultimately, fueling a surge in prices across a wide range of goods and services. This period of economic turbulence has brought into sharp focus the delicate interplay of factors that influence price stability and overall economic health. As we emerge from the shadow of the pandemic, understanding the forces driving these price fluctuations is crucial. This essay delves into the complex dynamics of supply and demand, consumer spending, and government intervention in the face of both inflation and deflation. By examining these factors, we can gain valuable insights into the challenges and opportunities that lie ahead for the U.S. economy. The pandemic's impact on prices is undeniable, but it's just one piece of a larger puzzle. Global events, technological advancements, and shifts in consumer preferences all contribute to the intricate dance of economic forces. By unraveling these complexities, we can better equip ourselves to navigate the uncertainties of the post-pandemic world. This exploration aims to shed light on the reasons behind rising prices, the potential consequences of these trends, and the tools available to policymakers as they strive to steer the economy towards a path of sustainable growth and stability. At the core of any discussion about prices lies the fundamental economic principle of supply and demand. This simple yet powerful concept dictates that when the supply of a good or service is lower than consumer demand, prices tend to rise. Conversely, when supply outstrips demand, prices generally fall. This delicate balance is constantly in flux, influenced by a myriad of factors such as production costs, consumer preferences, and external shocks like natural disasters, or, in the case of recent years, a global pandemic. The COVID-19 outbreak threw a wrench into this intricate system, creating bottlenecks in supply chains and disrupting the usual flow of goods and services. Imagine a popular toy in high demand during the holiday season. If a factory producing this toy experiences shutdowns due to COVID-19 outbreaks, the supply of the toy decreases. However, the desire for this toy during the holidays remains strong. This mismatch between reduced supply and consistent demand creates a scenario where retailers can charge higher prices for the toy, leading to what we perceive as price increases. Understanding the relationship between supply and demand is key to deciphering the complexities of price fluctuations in the wake of the pandemic. It provides a framework for analyzing how disruptions in one area can cascade through the economy, impacting prices across various sectors. Consumer spending forms the bedrock of the U.S. economy, accounting for a significant portion of overall economic activity. When consumers open their wallets, businesses thrive, leading to job creation, increased production, and overall economic expansion. However, this engine of growth can also contribute to inflationary pressures, particularly when spending outpaces the economy's ability to produce goods and services. The relationship between consumer spending and inflation is a delicate balancing act. On one hand, robust consumer spending is essential for a healthy economy. It fuels business investment, creates jobs, and drives innovation. On the other hand, if spending surges too quickly, it can lead to a situation where demand outstrips supply, putting upward pressure on prices. Imagine a scenario where consumers, flush with savings accumulated during pandemic lockdowns, unleash a wave of pent-up demand for travel, dining, and entertainment. If businesses struggle to keep pace with this surge in demand due to factors like labor shortages or supply chain disruptions, prices for these services are likely to rise. This delicate dance between consumer spending, economic growth, and inflation is a key consideration for policymakers as they navigate the post-pandemic landscape. Striking the right balance between encouraging growth and keeping inflation in check is crucial for ensuring long-term economic stability. The Federal Reserve, as the central bank of the United States, plays a pivotal role in maintaining price stability and fostering economic growth. It does so through its monetary policy tools, primarily by adjusting interest rates and influencing the money supply. When inflation rears its head, the Fed typically raises interest rates to cool down the economy, making it more expensive to borrow money and encouraging saving over spending. This balancing act requires careful calibration, as raising interest rates too aggressively can stifle economic growth, potentially leading to a recession. Conversely, keeping interest rates too low for too long can fuel inflationary pressures, eroding purchasing power and undermining economic stability. Think of the economy as a car navigating a winding road. The Fed, as the driver, needs to adjust the speed, interest rates, to navigate curves inflation without slamming on the brakes, causing a recession, or accelerating too quickly, fueling inflation. It's a delicate dance that requires constant monitoring of economic indicators and a nuanced understanding of the complex interplay of factors influencing prices and growth. While inflation often grabs headlines, deflation, a sustained decrease in the general price level, can be equally, if not more, detrimental to the economy. Deflation can trigger a vicious cycle where falling prices lead to lower consumer spending, business losses, job cuts, and further economic contraction. This downward spiral can be difficult to reverse, as consumers and businesses alike may postpone purchases in anticipation of even lower prices in the future, further depressing demand and exacerbating the deflationary pressures. Imagine a scenario where consumers, anticipating further price drops, delay purchasing a new car or home. This drop in demand forces automakers and home builders to cut production, leading to layoffs and further reductions in consumer spending. This vicious cycle can quickly gain momentum, dragging the economy down with it. Deflation can be particularly challenging for individuals and businesses with large debts, as the real value of their debt increases as prices fall. This can lead to defaults, bankruptcies, and further economic distress. The COVID-19 pandemic delivered an unprecedented shock to the global economy, disrupting supply chains, altering consumer behavior, and creating widespread uncertainty. These disruptions manifested in various ways, including factory shutdowns, border closures, and shifts in consumer demand, all of which contributed to price volatility. The pandemic exposed the vulnerabilities of tightly integrated global supply chains, as lockdowns and restrictions created bottlenecks and delays, leading to shortages and price hikes for various goods. Consumers, faced with uncertainty and changing priorities, shifted their spending patterns, favoring essential goods and services over discretionary items, further impacting prices in those sectors. Imagine a world where factories producing essential medical supplies grind to a halt due to lockdowns, while demand for these supplies skyrockets as hospitals struggle to cope with the influx of patients. This mismatch between constrained supply and surging demand creates a breeding ground for price increases, as scarcity drives up the value of these essential goods. The pandemic's impact on the U.S. economy highlighted the interconnectedness of global markets and the ripple effects that disruptions in one part of the world can have on prices and economic activity elsewhere. The COVID-19 pandemic also brought to light the phenomenon known as the bullwhip effect, where small fluctuations in demand at the retail level can reverberate up the supply chain, leading to increasingly larger swings in inventory and production. This amplification of demand signals can create chaos for businesses, leading to shortages, overstocking, and price volatility. Imagine a retailer noticing a slight uptick in demand for a particular product. To avoid stockouts, they might increase their order from their supplier. The supplier, in turn, seeing a larger order from the retailer, might ramp up production and increase their own orders from their suppliers. This domino effect continues up the supply chain, with each stage amplifying the original demand signal. The bullwhip effect can be exacerbated by factors such as long lead times, poor communication between supply chain partners, and a lack of visibility into actual demand patterns. The pandemic, with its associated disruptions and uncertainties, created the perfect storm for the bullwhip effect to take hold, contributing to the supply chain chaos and price fluctuations observed in recent years. In response to the economic fallout of the COVID-19 pandemic, governments worldwide, including the United States, unleashed unprecedented levels of fiscal stimulus, injecting trillions of dollars into their economies through direct payments to individuals, enhanced unemployment benefits, and loans to businesses. While these measures provided a much-needed lifeline, they also contributed to inflationary pressures by increasing the money supply and boosting consumer demand. The logic behind government stimulus is to provide a temporary boost to the economy during times of crisis, helping to prevent a deep recession and support struggling businesses and individuals. However, when too much money enters the economy too quickly, it can lead to a situation where demand outstrips supply, putting upward pressure on prices. Imagine a scenario where the government distributes stimulus checks to households across the country. This influx of cash provides a welcome financial cushion for many, but it also increases the amount of money available to be spent. If this increased spending is not met with a corresponding increase in the production of goods and services, it can lead to a bidding war for scarce resources, driving up prices. The challenge for policymakers is to strike the right balance between providing sufficient stimulus to support the economy without inadvertently fueling excessive inflation. As we emerge from the shadow of the COVID-19 pandemic, the path forward for the U.S. economy remains uncertain. The pandemic has left an indelible mark, accelerating existing trends such as automation and digitization, while also exposing vulnerabilities in global supply chains and highlighting the importance of resilience and adaptability. Navigating this uncharted territory will require careful monitoring of economic indicators, a willingness to adapt to changing circumstances, and a commitment to addressing underlying structural issues that may exacerbate price volatility and hinder sustainable growth. Policymakers will need to strike a delicate balance between supporting economic growth, managing inflationary pressures, and addressing long-term challenges such as climate change and income inequality. The COVID-19 pandemic has been a stark reminder of the interconnectedness of the global economy and the profound impact that unforeseen events can have on our lives. The economic fallout from the pandemic, including the surge in prices, has highlighted the importance of understanding the forces that drive economic fluctuations and the tools available to mitigate their negative consequences. As we move forward, it is crucial to remember that economic stability is not a given. It requires constant vigilance, a willingness to adapt to changing circumstances, and a commitment to sound economic policies that promote sustainable growth, price stability, and shared prosperity. The challenges ahead are significant, but by learning from the lessons of the pandemic and working together, we can navigate the economic turbulence and chart a course towards a more resilient and equitable future. This essay draws on a variety of sources, including economic data from the Federal Reserve and the Bureau of Labor Statistics, as well as news articles, academic research, and the author's own expertise in economics. The examples used in the essay are for illustrative purposes only, and are not intended to be exhaustive or definitive.